Have you ever wondered what separates winners from losers in investing? Sure, there is the luck factor, but is it just luck? No. Mainly, it's their mindset. The most successful investors think differently, spot opportunities others miss, and make moves that might seem crazy until they pay off big. Do you want to see how they do it? Well, in today's video, we will crack open the minds of the most successful investors to uncover the mindset shifts, strategies, and lessons that built their fortunes. If you are dead serious about building a fortune, you have to start thinking like the greats. So, make sure to stick around till the end because one mindset shift could be the key to unlocking your financial future. Invest in what you know. Have you ever walked into a test unprepared? If you have, well, that's exactly what investing in an unfamiliar business feels like. Warren Buffett, one of the greatest investors of all time, has one golden rule, and that is to never invest in a business that you cannot understand. Buffett has built his empire by investing in businesses that he understood, from Coca-Cola to Apple. And you know what the lesson is? If you don't get it, don't bet on it. Stick to what you know, and your investments will thank you. Warren believes that understanding a business means grasping its competitive edge, revenue resources, and long-term stability. He avoids speculative bets and prioritizes companies with strong fundamentals. For instance, his investment in Apple. It wasn't about riding a tech wave, it was more about recognizing Apple's brand loyalty, pricing power, and ability to generate cash. This discipline has protected Buffett from market fads and speculative bubbles, reinforcing the importance of knowledge-driven investing. Accept that mistakes are inevitable. Peter Lynch, the man behind Fidelity, Magellan, Funds, Record, Breaking Returns, has always stood by one thing. Even the best investors are wrong 4 times out of 10. He famously said, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. To put it simply, even the greatest investing legends face losses. But you know what sets them apart? It's the way they handle those losses. So next time when you see a stock tanking, don't panic. Instead, learn from it, adapt, and move on. Investing is never about perfection. It's about resilience. The ability to embrace mistakes, refine strategies, and stay in the game. That is what separates long-term winners from those who quit too soon. Lynch's approach, famously called buy what you know, has encouraged many investors to look for opportunities in everyday life. He spotted investment potential in brands like Dunkin' Donuts, literally by observing their popularity. Yet, he also admitted to missing big winners and making poor choices, proving that even legends endure setbacks. Think long-term. Prince Alwaleed bin Talal, one of the world's wealthiest investors, has a slightly different approach to investing. He says, "We are getting hurt, but I am a long-term investor. Short-term losses are just noise. The key to wealth isn't avoiding dips, it's surviving them. Be patient, think big, and play the long game." Alwaleed's strategy is simple yet powerful. Hold through the market turmoil and trust in long-term potential. His investments in Citigroup, Twitter, and other major companies were never about chasing quick profits, but they were about identifying businesses with staying power instead. Even when markets crashed, he remained steadfast, knowing that temporary losses don't define true investors. Instead, it's resilience that matters. Take Apple, Amazon, and Microsoft, for example. These companies have seen wild price swings but rewarded those who held on. So, the market will test your patience. There will be downturns and corrections, but history proves that those who focus on decades, not days, come out on top. So the next time the market dips, ask yourself just one question. Are you investing for today's headlines or tomorrow's success? Diversify like a pro. The pioneer of global investing, John Templeton, said it best. The only investors who shouldn't diversify are those who are right 100% of the time. Spoiler alert, no one is. Diversification is the key to long-term success. Spreading your investments across different sectors protects you from unpredictable shocks. Think of it like a sports team. If one player underperforms, others step up. So don't put all your eggs in one basket unless you're a magician. Now, Templeton's secret is global diversification. He searched for undervalued stocks worldwide, believing that investment opportunities were not limited to a single country. While others hesitated, he saw potential where others saw risk. But he didn't just diversify across countries, he also spread his investments across industries. By holding assets in different economic sectors, he minimized losses if one sector crashed. This strategy helped him navigate financial crises and still come out ahead. So don't just diversify, think globally. Explore opportunities beyond your home country and build a well-rounded portfolio that weathers any storm. Avoid the pitfall of envy. Can you imagine being in a race where you're constantly checking your competitor's speed instead of focusing on your own stride? Now, can you imagine winning that race? No, that can never happen because when you're looking at your competitor, you're basically ignoring your own journey. Now, this is what most investors do. They obsess over others making money faster, feeling frustrated when they fall behind. Buffett and Munger have a radically different approach. They refuse to let envy dictate their decisions. In Munger's words, the idea of caring that someone is making money faster than you is one of the deadly sins. Envy is a really stupid sin because it's the only one you could never possibly have any fun at. Like, what's the point of being distracted by others' success? Great investors stay committed to their own strategy. So, the focus is not on beating the market or chasing trends. It's on making rational, long-term decisions. Buffett's iconic advice sums it up the best. Be fearful when others are greedy, and greedy when others are fearful. Envy often leads to impulsive decisions, like jumping on hype-driven stocks or panic selling during market downturns. So, if you want to work like the best investors out there, resist this urge by staying rational and detached from short-term fluctuations. The pursuit of learning. Buffett once claimed to have read every investment book in the Omaha Public Library by the age of 10. Even today, he spends most of his workday reading. Do you know why? Because continuous learning is the foundation of long-term success. Munger believed that the key to Buffett's success was not just intelligence. It was his ability to keep expanding his knowledge. Because great investors never stop learning. Whether it's from books, experience, or even their mistakes, it is their relentless pursuit of learning that keeps them going. This pursuit of knowledge is exactly what sets successful investors apart. They are not just looking for quick wins. They are building expertise that compounds over time. As Buffett puts it, the more you learn, the more you earn. So, to be a successful investor, you have to embrace lifelong education. Markets evolve. Economic conditions shift and new opportunities emerge. Those who consistently adapt by learning new information position themselves to make the best investment decisions over time. Adapt or perish. Michael Steinhardt, one of Wall Street's most legendary traders, once said, "Markets are always changing, and a successful trader needs to adapt to these changes." This simple yet profound statement is the essence of long-term success in the financial world. Markets are always in a state of flux, shaped by economic cycles, geopolitical events, technological advancements, and sometimes shift in investor sentiment. So, strategies that yield high returns a decade ago may be obsolete today. Now, traders who refuse to evolve suffer from the risk of being left behind, while those who embrace change gain a competitive edge. Steinhardt's philosophy emphasizes the importance of staying informed and being flexible because a successful trader has to continuously refine his strategies, learn from past mistakes, and adapt to new market realities. Whether it's the rise of algorithmic trading, the impact of macroeconomic policies, or even the growing influence of AI and finance, the ability to pivot is very crucial. In today's fast-paced financial environment, rigidity is literally the main ingredient of failure. So as the saying goes, what worked 10 years ago won't work tomorrow. The most successful traders don't just react to change. They anticipate it, embrace it, and turn it into an advantage. So if you want to keep evolving, you have to stay informed and flexible. The lessons from the world's top investors can change the way you see money, risk, and opportunity. Let us know your favorite advice in the comments below. And if you found this video helpful, make sure to subscribe to our channel so that you can stay in the loop and never miss out on any of our videos. Subscribe now. See you in the next video.